Hi, everybody. My name is Kevin Darby, and I'm going to be presenting my paper called Time is Money, the Equilibrium Trading Horizon and Optimal Arrival Price. I just turned the camera on to say hello, and I'm going to share my screen, and we'll work through a Python notebook together, kind of working through some of the parts of the paper. I'm actually wrote some Python that calls into some of the C++ we use in production. So I think it should be an interesting thing. Thank you, everyone, for your attention. Okay, here we go. So the name of the paper is Time is Money, the Equilibrium Trading Horizon, Optimal Arrival Price. Like I said, I'm Kevin Darby. I work at CQG. And basically what CQG is we are a 43-year-old fintech. We connect to a variety of futures and options and equities, market data sources. We route trades to a variety of venues, both exchanges and OTC and broker networks. And we also have a suite of high performance algos that are basically built by me and a team. And actually, this paper was the foundation of our arrival price algo. So let me get right into it. So the abstract here, there's a lot to it, and I'm just going to hit some of the highlights for the sake of brevity. But basically the idea here is when you execute a futures trade, and it doesn't have to be that big, you're essentially exposing yourself to two specific risks. So there's variance risk and liquidity premium. And I'll show you what I mean by those things. So what we do to sort of solve for this case is we construct this hypothetical at the money option within arithmetic Brownian motion. And we invert the Bachelier model to compute an inflection point between implied variance and liquidity cost. From there, let's move on here. So we have to create sort of this trading model. And the trading model we create is basically arithmetic Brownian motion. So what is arithmetic Brownian motion? Arithmetic Brownian motion is essentially defined by this differential equation here. So the change in the thing, or ST, is basically one known component, where R here representing interest rates, and as I'll show you later, these are very short time periods, so we kind of ignore interest rates. And then basically this future value is determined stochastically. So randomly determined, some part of the future value of S is deterministic and some part of the future value of S is stochastic. So in arithmetic Brownian motion, the sigma measure there is essentially an addend that gets multiplied by a random number. In the more famous geometric Brownian motion, sigma is a factor, but for short time periods, due to the way the order book works, I chose arithmetic because it's a better approximation of the dynamics of the actual order book. And what do I mean by when I say order book? Order book, it basically looks like this. So I think many of us here have seen a order book for futures. This is an old screenshot, basically advertising futures for sale at a current price here, and then offering to bid or purchase futures for a smaller price here. So if you think about what this does and how you execute, you have a choice. So your choice is either to execute your order passively. So let's say you're going to do a sell here, or a liquidation. You can either basically go through and pay a liquidity premium by essentially taking the liquidity at these three levels here, or you can rest your order here at the offer price and hope someone comes to you. So basically the effective immediate fill price by sweeping the order book can be thought of as arrival price, which we're defining as the mid price between the bid and the offer, plus the liquidity premium. So as you can see here, and we'll check my math here in a second, that if I wanted to liquidate 100 futures at this price, I would basically be paying $44.50 or 0.445 per lot. And because E-mini futures have a multiplier of $50, this is essentially $2,225 liquidity premium that I would be paying to get the order done right now. So you can see here I define this term, sweep to fill minus arrival price, absolute value of that's liquidity premium. I'm just checking our math here. So the first three levels is 18, 36, and 47. So the cost in points is 44.5, and the cost in dollars is 22.5. Okay, now we're going to talk a little bit about options. So if rather than paying the liquidity premium to execute immediately, you choose the path of variance risk, we can quantify the risk. So we can quantify the expected value of the change in the asset price under arithmetic Brownian motion as this expression here. There's our sigma number. T minus T is basically the horizon, and then over 2 pi kind of arises. I'll show you why here. So this is basically the expected move of the asset over some time period. And we can go a little further with that. So if we look into the Bachelier options model, the price of the vanilla call is given here. You can see here we define D1 and G. And if we do a little bit of algebra, if we decide that, here we can see here that the ST is the forward price of the asset, R is the risk-free rate, K is the strike, big phi and little phi are the cumulative normal and probability and density functions respectively, you can come up with the idea here that the half a straddle, is basically sigma times the square root of t over 2 pi, if you simplify all this here. And what you do is basically if you have ST equals K, then D1 becomes 0, and then you've got that above. Now, just pause to remember here, this is the normal or Bachelier options model. It works within arithmetic Brownian motion and says that the underlying price, so the asset price, is normally distributed. This is not the Black-Scholes model, which works within geometric Brownian motion and says the underlying log returns are normally distributed. They're different models. They're related, but they are different. Okay, now we come to the martingale being the fair bet. So the idea here is that the CLOB, or the central limit order book structure, gives you some optionality. You can take variance risk in executing the trade by trying to execute passively over some amount of time, or you can pay the liquidity premium instantly to mitigate that risk. So now if we know the cost of liquidity and we can compute the implied sigma, or this notion of volatility, then we can calculate, basically invert the model as I did above and calculate the maximum tenor or time of the half straddle purchasable with an investment of the liquidity premium. Here, the implied time is exactly equal to the future point in time at which variance risk equals the cost of liquidity. Okay, and you can see here, I've got my equation set up here. I've got L set up, and T star, if you do a little algebra, T star answers this question. If we map the dynamics of S to arithmetic Brownian motion, and we know sigma, and we know L, which is the cost of liquidity, we can compute the optimal time over which to work an order. It's kind of a big deal. So if you want to do an order right now, do an order right now and pay the liquidity premium. If you don't want to pay the liquidity premium, you can compute the amount of time over which to work an order to where you'd be essentially exposing yourself to the same variance risk. And the idea there is some of it can go your way, some of it can't go your way. So we'll get into a couple of ways of how you compute sigma. There are many estimation techniques, but we use two primary estimators. There's a way to use open, high, low, and close. And I've cited a couple of, there's two papers by Garman and Class a long time ago, and then there's one more recently by Yang and Zhang. I'll get to that in a second. Or you can use a time series. We actually end up doing both. So we have a little setup. You always have to fix the path because it's Python. So here we look at OHLC. Here's those papers I mentioned there. And here we're going to actually just call right into the shared library we use in production to actually create a rival price. So I just got some historical data here. Here's from 9/24. Here's from 8/8. On 9/24, the VIX open was 15.87. On 8/8, it was 28.34. So I just feed these in. And here I've basically got, these are daily volatilities. And to annualize those, we multiply by the square root of 252. So the volatility, the realized volatility by OHLC here on the first date is 7%. And on the second date is about 22%. So, here that's kind of a way it underestimates VIX, but we're getting closer here. Second technique is to use a time series. There's even a few ways to do that. So here I'm basically reading a CQG parquet file, which I'll show you what it has. Here's a little sample. So we've got nanosecond timestamps. We've filtered for our security ID, in this case, EASZ4. You can see here, kind of set this up. And then this is basically historical market data, and it's got a whole bunch of stuff here. So it's got some trade aggregation here. It's got last trade size, some of the trade sizes. It's got all the bids, all the offers. There's implied bids and offers, which isn't really a thing in the E-mini market. And then we've got some MBO, market by order statistics. So basically stats on what the actual constituent orders of each level here are. So I do a little bit of setup. I'm now essentially doing a lag here. So I'm just looking at the previous mid. I'm creating that. And you can see here, I'm just showing you this again so you can see there's the previous mid and there's the return of the previous mid. And so, like I mentioned, there are a couple of ways to do this. So the first way to look at variance would be to look at the actual just, Python or variance of the price so far. So the price so far in the day, this started at 9:30 in the morning. We went about halfway through the parquet file. So if you look here, the variance of the price so far is about 5.93, and you got to take the square root of that to get the daily vol. and that is 2.4. That's not much. The next thing you could do is you could compute realized variance, and basically the sum of the squared returns is the realized variance. So we do a little setup here. And so we can look here. So if we decide that this file is about 30 minutes long, I compute the seconds per day and minutes per day, and I compute this thing called t-factor to try to see which variance is better, the sum of the squared returns, or take the actual price variance and then multiply it forward. So the estimate from the price variance times time factor is about 16. And these are, I should pause here to let everybody know what that means. So these are basically in points. So normal volatilities, were like Black-Scholes log volatilities, are in percent, but these are in points. So this is basically saying that we expect on this day the E-mini futures to move 16.88. Our estimate from OHLC, as we did above, was 27, and our sum of the squared returns was 26. And so, I like the sum of the squared returns, and that's usually because there's no T. You don't actually have to divide by T. And so I think if you look at price variance, because in a historical time series, the price doesn't change a lot, maybe like some particular facet of the order book changes. And so it causes a lot of rows with no price change. And because you have to divide by the number of rows, basically for the variance calculation, it kind of understates it. But there's no T measured in the sum of the squared variance. So that's what we're going to use. We're going to use 26.21 as the vol. So any questions on vol?
Hey, that makes sense. Hey, Kevin. The question I've got is, so are you also thinking about so you have this, you're getting this estimate and you've got an order in, and are you thinking about how much volume should go in per that unit time? Or maybe I'm getting ahead of that. I'm just trying to think, like a lot of thoughts are going through my head as you're going through this.
Sure. Yeah, actually, I'm getting to that next. I'll show you.
Cool.
Okay, thanks. Here we go. Okay, so now, as Ari mentioned there, there's only so much volume you can do in the market at a time, because if you think about our order book, there's, price and size. So we have a vol estimate. What about the price of liquidity? So we're going to pretend we're going to buy 100 here. And so let's look at, I just picked like a start row just halfway through at random, halfway through the file here. And so we're going to look at the order book here. Okay, so if I wanted to buy 100 of these guys, okay, I could get 58 of them done at 5778, and I could get 62 of them done at 5778.25. So I look at the price of advertised liquidity up the entire book to basically compute this thing I call L, or the cost of liquidity. So here, for a trade quantity of 50, well, all of what I need is at the first level. So the liquidity cost is actually very low. But for the trade quantity of 100, I've got to go up another level. So the aggregate liquidity cost there is 23 points. And so I'm just checking the math here again. So you can see you're going to get 58 of these here, 58. And then so this is saying we're going to pay half a tick from midpoint here. And here we're going to pay a tick and a half from midpoint here to get us 23. So now we have all the variables, and now we can actually solve for T, or T star as I call it above. So I have the cost per lot, so I'm dividing L by how many I want to do, which is 100. And then I'm basically calling my inversion here, my optimal T. And I actually compute it twice. I compute it with the optimal T here, so this is in minutes. So for 100 lot, I should take about 0.7 minutes to do this trade. And if vol was twice what it is, I would take about 0.17. So there you can kind of see what the effect that this sigma parameter has on it. It's not linear, but it definitely has an effect. So now I'm just going to, we'll reach a little bit of a conclusion here. So T star is the equilibrium trading horizon where variance risk and liquidity premium are equal, given an instantaneous cost L, and then which is the half straddle, and then backing out this concept of volatility, or sigma. So if we have T star, then you can create a continuous time arrival price. So if liquidity never changed, and if sigma never changed over the course of an order, you could just basically do this and just plan out ahead of time how you were going to execute your order over this specific horizon. However, As we all know, the order book moves around, price moves, and vol moves, but it moves slower. But if you have a really large order that's supposed to take a really long time and some event happens in the middle of your order, you should be able to react. So this is my continuous time formulation here, where it's essentially a linear system, but the parameters are moving around. So to review, you have an order size, you compute the cost of liquidity, or the price you would pay to basically do it now. You say, hey, that's actually my options price. Then you compute your sigma, or your volatility, and you basically invert the Bachelier model to go, I have price, I have sigma, how much time should I work this order? And this is all under the sort of framework of arithmetic Brownian motion. Now, what if you want to mess with it a little bit? In the paper, I had a kind of an overly complex example of there are reasons why you might want to be biased on one type of risk or another. So there are reasons why you might want to do more of your order towards the beginning of the equilibrium horizon. I think I gave an example in the paper of someone who was trying to hedge a long gamma position. I kind of simplified that. I left some of this out, and I'm going to give you version 1 of the bias framework. I'll give you version 2, which I think is a little simpler and actually has a nicer quality in there as well. So, okay, version 1 here, I'm basically looking at the profit that I expect to get over my equilibrium time horizon of my long gamma position. I create this K, which is sort of an urgency factor. And then for A, I'm basically using hyperbolic sine here. I'm using the ratio of basically K times how much time is left versus K times the whole time, sine of those. And then for positive aggressivity factors or urgency factors, you use tan H, you modify the XT, which is the position at time T. And basically that's how you do it. Version 2, it just did a little simplification here. So I want, instead of using sine H and tan H, I'm going to use sine H for negative, and I'm going to use a sort of factorized arc sine H. And the reason is when you invert sine, because you're kind of bounded to, I think it's negative pi over 2 to pi over 2. And so you have to do some factoring to make these things match. And then I just have this R factor is 1 over AG plus 1. And at my K, I lost my to the power of 1 over ln2 here. I'll tell you why I did that in version 1, why I don't want to do that in version 2 in just a second. And then here ZT is just whatever that F was of the same ratio. So back to the Python again here. So I set up my F1, F2. So this is for negative, this is for positive, and this is the new version here. So if you look at what this does, what you need to do is basically come up with a way to, now that you know how much time over which to work your order, now you can kind of mess with it a little bit. You can do more in the beginning, you can do more in the end, but you know how much time it's got to take in total. So you can, this is the way you bias it. So here in green, I have the negative space. So it's concave down here in the beginning, the concave up, and then the opposite here. If you want a positive bias, you want to do more, push more towards the end. Here I compute the liquidity, the urgency factor. There's some numbers that represent, but this is basically with urgency 1.0. If you think about just the vanilla case would basically be a line down the middle there where half of your order is done in half of the time. So the original optimal time in seconds is 41. So it's about 42 seconds. And then here I just compute the half-life for urgency factor 1. So basically here, if you wanted to do more in the beginning, so that's the negative bias, your half-life instead of 21 seconds or so will be 13. And then here, if you wanted to do more towards the end, you'd be 28. Now, I'll show you why I changed what I changed. So if I go up here, and this is to use the original version here. Oh, Python and its capital Booleans. So let's do that. Those curves kind of look the same, right? But the devil's usually in the details. And here. So you get more extremes when you use the exponential, but you get some asymmetry, and I didn't really like it. So you're about a quarter of the way through here, but then, you're not 75% of the way through over here. So if you use this more symmetrical bias framework, although you don't get quite such a huge response here as you did for a variance factor 1, you're about a third, and then you can come through here, and there we go. So for a 2, it's about 22 and 77%. So basically, and I showed you here how we just did a little algebra to find the half-lives of these things here. Use basically the arc sine and the sine or the arc tan H, both of those. Any questions about bias or liquidity or any of that good stuff?
if you're willing to answer, I have a question about if I read correctly or when you went over it, higher vol means shorter time. Is that right?
That's right.
Okay, so how do I interpret that shorter time? Does that mean that I should have essentially greater urgency as a trader because it may get away? Because I guess in some way I was thinking, well, if the vol is kind of higher, maybe, it's going to pop and then come back and maybe some, I guess I'm thinking mean reversion. So can you take me through that a little?
Yeah, sure. So the bias I just talked about is a bias like that's in your mind. It's you want vol risk or you want liquidity risk, and you have a reason for that. You have some axe and you're grinding it. The idea we're just without any bias. So higher vol basically exposes you to higher variance risk or not getting your price. So yes, you could get your price, but you could also have a higher probability of it not getting your price. Let me take you through down here in the appendix about what you could do with some sort of mean reversion to actually affect the time that you do it. So it's actually a pretty good segue here. Let me not talk about microstructure. I'm going to come back to this. Let's go to the appendix. So here, okay, we'll go back up there to the microstructure and the simulation, but let's talk about this. This is important. So in the appendix, we talk about short-term price indicators and drift. This is kind of what Ari just mentioned about what if there's some sort of mean reversion? Can I change this equilibrium time horizon to sort of capture some of that? So we restate the SDE. Instead of using interest rates, which are effectively zero over these really short times, we just make a mu here, and this mu is drift. We talk about it a little bit, but it changes the inversion. So remember before that we got this really nice algebraic form when ST or forward minus K was zero. Basically, we got a nice, just divided by 2 pi, and we were done. You can actually invert this model when you have a drift. So you have to kind of define what your drift should be. Of course, if you know the future value of the market, you would act accordingly, but you don't know. So you don't necessarily know what's going to happen, but you always do know what did happen. And so Peter Jaco wrote a really nice sort of paper, a note on how to find implied normal volatility from price. So I kind of changed his algorithm a little bit to find implied time in a more complex scenario where D1 doesn't equal 0. So we can look here. So the optimal time in minutes from before, the base time is like 0.7 minutes. If drift comes our way, if the market comes our way here, that's how we want to define drift, it shortens it. So the idea being, if the market starts coming your way over the course of your execution, you might want to speed up because you don't know if it's going to get this good again. If the market moves away, you can see here it expanded, which means we slow down. When time expands, we slow down. And it really just matters how you define the utility function here. This is a nice thing. You just can't take it too far. So when the market moves away from you, if you slow down, if you do that forever, you never get done, or you get done at a really bad price and a drift. If you're really right and the market comes towards you, you may actually want to invert it and slow down. And we have switches in the actual implementation so where you can decide how to do this. But basically, the idea of drift or mean reversion is essentially encapsulated in this forward price, where our strike is the arrival price. We get back up here. Our strike is the arrival price, and forward price is what we think or what the price is now after basically T0. That answer your question a little bit?
Yeah, that's pretty cool, but I even want to get simpler than that.
Okay.
And 1 vol, and I get an estimated time of, let's just say 0.7 minutes as you started, and then there's another one for 0.2. Mm-hmm. What am I doing with those numbers? So I want to be really Labrador-ish. So, I've got whatever it is, 55.77 at 55.78. I know it's wider than the market, but let's just go with that.
Sure.
And it says, okay, you've got 0.7 minutes. So now I say, am I saying I'm going to go on the bid? Am I saying I'm going to take the offer and there's an offer for 50, but I want to buy 100 and I'm going to leave it there for 3/4 of a minute? What do I do with this information? And I'm trying to get an idea of oh, I need to do this fast because the vol is there. So if it doesn't get hit in 10 seconds, then just take the liquidity there. Is that what I'm interpreting correctly?
Sure. So the time horizon is the time over which you should do the execution. So how you do the execution, that's actually a great question. So if there's 50 on the bid, do I join the bid? Do I join the offer? How do I do this? So now we got to talk about microstructure. Okay. So here's an example here where this is for an oil spread, where even if I had my implied time, and my implied time was whatever it was, I'm staring at this thing. And if I'm a seller, I'm definitely going to join the offer for some period of time to sort of extend that equilibrium horizon, because by extension, there's a high probability that it would actually getting filled at the bid would reduce my overall costs. And so how does this work? So there's some existing literature that I read a ton about this, but two of the best ones I found were by these guys named Ramakant and Adrien de Lerard in 2012. And they basically create sort of models of the different queues here as basically Markovian queuing systems. And so we call into here, and if you look, they actually get into it a lot, and where you can actually look at the bid size and the offer size, but it's also more than that. It's the rate of bid orders or sells coming in to sell at the bid versus the rate of orders coming in to buy at the offer. And then the mean size of those orders, and then the correlation between whether there's mostly bids or mostly offers. And if you come up, basically, they created this function to say, or this formula to say, this is the probability of this market going up. And then, so if you're a buyer, you don't want it to go up, you want it to come to you. So it's 1 minus that. And then, so internally, for each slice, right, we know that over time, we're going to, over this equilibrium horizon, we're going to slice up the order in some way. If we have a bias, it's going to, do the hyperbolic solution. If we don't have a bias, it's just going to be a line. So every slice of the order, we essentially either join or don't join based on the probability that we'll execute passively, thereby reducing the overall cost we pay. Does that answer your question?
Yeah, that makes sense. So you're observing like the rate of like trying to see, there's more buyers or sellers, right?
Right. And it's basically the probability of the opposite queue being exhausted before we're filled at our place in the order book. And so we monitor all that, and we send slices passively if there's a probability that we'll get a passive fill, and we send slices aggressively in order to stay within the equilibrium horizon if we don't think we'll get a passive fill. And actually, passive fills are really important kind of into the entire. So, at the end of the day, an arrival price algorithm is basically benchmarked to two metrics. And I don't think I mentioned it, but way up at the top of this thing, you're benchmarked to mid-market, which is most people consider arrival price, but you're also benchmarked on something called sweep to fill, because most of the time you should do better than a market order if you're going to use an algo. So I actually built a little simulation here. This is a Python wrapper. I used the technology called PyBind 11. Above those were just C types, but down here we had some more complex structures. So basically, this is our internal simulator, order matcher wrapped in Python. I load here our bid and offers in from the Parquet file that we talked about before, and then I just show you here. So that this is basically one of them. So okay, I get the book. Here's my top of the book, and if I send an order in for the offer, I get a fill here in nice JSON format. And then here, it's 57. If it was 58, I took one and it was 57. So that just kind of demonstrates the thing. Then I could define a couple other functions here. So this is just a send limit order. It takes the bid offer and then decide in a Boolean whether it's passive or not. And then here we go. This is going to decide whether a slice is passive or aggressive. We're going to call the diffusion probability function that we talked about up there. If it's a buy, it's 1 minus. And then basically here we're just giving this a threshold. We're saying if the probability of success is greater than 50%, we're going to do it passively. If not, don't do it aggressively. Now, in real life, those probabilities will change. So you might be resting an order to rectify an imbalance, and then the imbalance changes. Somebody was ahead of you in queue, or somebody swept it, and the probability then of your order happening passively changes. And so in the real implementation, we monitor this in real time and pay these things up if the probability changes. We're not doing that here in the Python notebook. So I just wrote a simulation. So I look here for my optimal time. I compute my optimal time with my cost per lot, with my sigma, my orders of buy, and my size. And I go through here, and for each second, you can chunk this up. That's actually a nice parameter too. So you can analyze the market every second. You can analyze the market continually. You can analyze the market every 15 seconds. You get different child slices. And so there's a little bit of nuance here in how you would do it, but I just go every second, and I basically come in, get my book, and then I decide passive aggressive, and I either send an order passively or aggressively. I get matches, I get my fills from the matches, and I compute average fill prices. And then again, I went through the exercise of watching as liquidity sort of came in or was removed from the market that actually changed the optimal arrival price as it's executing. So here we go. So we did a simulation where we do not allow any passive orders. And we actually did pretty well. The market kind of came to us a little bit, but we actually ended up executing over 54 seconds. The initial time was 41, but we executed over 54. And that's because liquidity kind of in the middle there went away. So our slippage to mid-market, we beat mid-market by 68 cents. Our slippage sweep, we beat a market order by 91 cents. Now, if I allow passive orders to be true, this is a pretty great fill. The market came to us on this one. But if we allow passive orders to be true, it gets even better. So our slippage, negative numbers for slippage are good, by the way. Positive numbers means you didn't beat it. So as opposed to 68 cents for passive orders, we beat by 89 cents and beat market order by $1.12. So that means along the way, over this minute, there were opportunities to take advantage of imbalances in the market that essentially gave a high probability of taking a passive fill and reducing our overall implicit execution costs. This is a big deal. So with only aggressive children, we beat a market order by $4,500, like real grocery store dollars on your 100-lot E-mini order. And arrival price with the probabilistic model of aggressive and passive, that was $5,600. If you think about it, so I just have a couple notes about the simulation. So optimal time increases, liquidity dried up, and then decreased during the execution. I actually can show you that. So if you look here, down here in each of these frames, you can see that liquidity is kind of going away, right? You've got 11 lot here, and it's like getting more expensive to execute. So given that vol has stayed the same over this execution and the price, the liquidity premium has gone up, it slows down. Vol, I did keep vol constant through this execution because it's just a minute. Usually vol doesn't move in a minute. Volatility could change over the course of the order, but we didn't do it. And then I mentioned this before, but I simplified the pay up model to just compute a point probability right then, and then basically pay up all orders at the end. And I actually left drift out. I did not speed up as the market moved toward us. And then we've already examined that idea of drift. So any thoughts or questions about the simulation? Okay. So now there's a little bonus here. We've got a little bit of time left. So we'll go through here. This was drift. Okay, now finally, hey, it's 2024 and you haven't said anything about machine learning. So I wanted to wait till the end because I do have something to say about it. So from above, passive orders are important. We saved real money sending passive orders when the math told us to send passive orders. It turns out that there are nice queuing, Markovian queuing systems do a pretty good job of this, but machine learning models do better. So I'm just going to walk you through the quick setup of basically what we use in sort of an upcoming version of our arrival price and our pay up algos at CQG using machine learning. So using the same basically setup, instead of lagging one behind, I have to basically give the machine learning model a future, something to predict. And I can show you that. I give it here. This is interesting. In a half hour, there's lots of ticks, but on this particular day, there's not a lot of up and down ticks. There's a lot of unch ticks. So the idea for our machine learning model is to classify one of these three states. So 1 is unch, 0 is down, and 2 is up. You can see, of almost 600,000 unches, there's almost 8,000 downs and 8,000 ups. I'm going to split my data here, my prediction factor. So I'm going to train on the first 80%, and I'm going to predict on the last 20%. Fix the path. Then I create my features. Basically, to use this sort of gradient boosting technology, you have to come up with a nice set of features. It took me a long time to figure out a nice set of features. If you plow just order books into machine learning models, it will not work. You will not get good data. Your models will not live a long time. But if you do some nice things that I've learned along the way, you can kind of make this work. So here's my featureized data. I set it up into training sets, and then I get a set of boosting params, and I instantiate our booster. So let's talk about this for a second. So our gradient booster is basically a fork of LightGBM. So we've made a couple of tweaks. We do a couple of things a little bit differently than vanilla LightGBM. So this is actually just another Python wrapper instantiating C++ object. We do some fitting, and we get some probabilities. Now here again, we have a probability threshold. So if 0, it means take the largest likelihood of what might happen. If it's non-zero, it means it'll only say the next tick is going to go up or down if the probability of that move is equal to or greater than the threshold. So remember, what are we trying to analyze here? We're trying to say, okay, we have a market, we have a current bid, we have a current offer. We want to predict, let's say on the offer side, whether the next offer is going to be up, down, or unchanged, given those three states, right? So 0 is down, 1 is unched, and up is 2. Here we're going to have our probabilities, and we're going to give you a little plot here. So there's a lot that happened in here. This is our training in the blue, prediction in sort of the weird yellow, and this is the section of the market over which we predicted. So we trained over this blue, and then in the gray here, this is the part we predicted. So it's about a $5 or $6 range here that we predicted. So it had some good movement. And I'll show you here the accuracy. So this is our reckoning of accuracy. So we make two measures. So one is capture, that is, of all the moves that took place, how many did we accurately predict before it happened? So that's here of the 1,383 ups in this half hour, we got 84 of them. And then of the downs, we got 85% of those. And then the other measure that we do is we do a accuracy of the prediction. So because you're predicting the future, there are more predictions than there are future events. So this is capture here in the mid 80s. And then this is the notion of, for each prediction that was made, how many were correct? 75%, and it's thousands. How many were incorrect? So incorrect here would mean that I said it's going to go up, but it went down. It's 14%. And how many, I call it a scratch because we're talking about pay-ups. And that would be how many times did I predict that it went up, but it didn't move? And they're in the mid 70s. So this is a pretty sort of run-of-the-mill prediction on liquid markets that we see for a machine learning stack at CQG. And these models, sort of how you train and when you add a new model is like probably the subject of another Quantopian presentation perhaps. But suffice it to say that if you wire in the machine learning just at the very end, you can, I should just say, don't take our word for it. You can use the sklearn accuracy measures here too. And we actually, we do a pretty good job there. That's just to keep us honest. So if you wire in the machine learning to the bottom of the arrival price algorithm, which is kind of what we've done in our new version at CQG, you can get really high accuracy and thereby more passive fills, causing you to pay less implicit trading costs. And then I've just got basically our algo webpage here. I've got the paper as it was published. I've got my LinkedIn, and I wanted to show you two things here. So this is a historical, we do a simulation of our arrival price. You can see mostly we do a pretty good job. Here's slippage and slippage sweep. This is E-mini. This is from a couple of days ago. Occasionally you have a couple of heartbreakers in there, but for the most part, you save money if you work orders using arrival price. And then I have our front end here, and I did a couple of these simulated trades in a live market. And you can see here, we've got our live slippage methods, our metrics here, slippage sweep, and then some of what the algo was thinking. Some of these, if you look at total vol and you can look at normal vol, you can kind of see what the algo engine was thinking when we did the simulated trade. Come back here. Any questions on adding machine learning to the bottom of arrival price or anything else that I've talked about today?
Thank you. That was super thought-provoking.
Okay. Thank you all for listening. Like I said, I'm Kevin Darby, CQG. This has been my presentation on time is money, the equilibrium trading horizon, and optimal arrival price with a machine learning kicker at the end. Thanks, everybody, and see you soon.